Hey, beautiful people, welcome back to Invested. And all the articles coming out, it's silly, but it's about time. And everything is very negative. Sentiment is very negative, right? And this article is like, blood in the office and multifamily spaces. The CRE, commercial real estate dominoes are falling. And this individual posts all these articles about downtown LA, Bank of America Plaza, blinks of losing $400 million of office tower. Birmingham, Alabama, the tallest building is facing foreclosure. San Francisco, $700 million foreclosure. Goldman Sachs, The Bluff, Playa Vista. Yeah, I mean, there's just so many. 777 Tower, downtown LA. Man, that was my favorite building when I was working in downtown LA. I think the 777 Tower is called 777 Fig and is, I think, the newest building that was built. Of course, the Wilshire Tower by the Crane Air. That was the newest one. But prior to that, I think that building was built in 2004. It was a beautiful white building. I think the architecture was great. I think that's my favorite building. But that is foreclosure. Yeah, because Brookfield owned that, plus the PwC building and that. And they had, I think, $1 billion of debt, and they kind of defaulted. So that's up for foreclosure as well, too. So this individual kind of named a lot of the city, but he's mostly in LA. Oh, man. And San Francisco and California. So, I mean, this trend is not only in California. I think systematically California has bigger, more valuable assets, and they're foreclosing. So a lot of the headline news is going to be that. But, you know, New York's seeing some of that, Chicago as well. But surprisingly, like even in Nashville, Austin, Phoenix, right? Or even Florida, like Tampa, those real estate prices on CRE just went up astronomically during COVID, right? Because you heard all the news, blue states losing all their businesses to the red state. And if you really think about it, Texas, Austin, red state. I mean, Austin's blue, but Texas itself is red. Nashville's in Tennessee, it's red. Florida, Arizona. Arizona is purple, it's a swing state, you know, but they lean a little bit more conservative, more red. But why are those businesses going there at the time? Because they had a lot more freedom. The lockdowns was not as restrictive. And Arizona has income tax, but not as high as California or New York. But if you think about Texas, Florida, and Tennessee, there's no income tax. So with the freedom, cost of living, and no income tax, you know, there's a lot of, you know, companies that migrated, people who moved out to those locations, just brought up the real estate prices astronomically, home values and things of that nature. So if you look at it now with all these office and multifamily spaces falling, Austin, Nashville, Phoenix, they're crashing faster as well. Because it's logical. If it goes up higher by percentage, you're going to drop more, right? So you're seeing that as well. And I have seen a lot of good developers who took a lot of risk, and I get it. At that time, it made sense for them. Had really unrealistic underwriting because they approached us in JVing or LP partnership. You know, we declined because I just thought their rental growth was just unrealistic. I mean, Austin already had double-digit growth for the 4 or 5 years, and now they're going to project out another 5-6 years at 8% growth, 8, then 5. I mean, that is just pretty crazy, right? And those developers, and they have successfully completed their Class A multifamily, wrap style, garden style. Beautiful, right? But they're not getting their rents. They can't get if they can't hit their pro forma and they can't get their occupancy up, guess what? These developments, they take on bridge financing or construction financing. Most construction financing is 3 years, and they're much higher than a permanent financing, right? But you ask, but then they build it beautifully. Why don't they get a permanent financing versus construction? They can't refinance it because the max proceed is all based on interest rate, which is DSCR, debt yield coverage, plus how much NOI that asset generates, right? Net operating income. And it's not hitting their underwriting. So even though when they refinance, the proceeds, the loan proceeds, is not even enough to cover their construction debt. So they're underwater. So you're seeing that a lot even in Phoenix, Boise, not as much, but Boise's kind of seeing that weakness as well too. Nashville for sure, and Austin's for sure. Even Dallas, you're seeing a little bit of weakness, but I think Austin went up a lot more. So when you're seeing the blood's in the office and multifamily space, that's true. And I think it's nationwide. Areas that have gone up much higher is coming down much quicker. And it's also retail as well too. A lot of asset classes are having the same issues, right? So it's not only one, it's just office and multifamily, you're seeing more of it. because multifamily side is more of the newer development, and office historically, even before the pandemic, had a hard time because, most office are modified gross and the rents haven't really escalated, adjusted for inflation enough compared to the commission and the improvements they have to put in to re-tenant the space. So it was already a very tough business model, but with the pandemic and hybrid work or remote work have really changed the landscape. So you're going to see that office asset class struggle even further. There are going to be some select office, like suburban office, that is more class B minus, more cost efficient, I would say. And there's still going to be traditional businesses that still need office space, right? So you can't do everything remote. No one could work at home like forever. So there's going to be specific businesses that still need office space, but they're not going to go to class A where you have to pay $250 to $500 per parking spot. You're paying $56 per square foot. And blah, 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 right? So they're going to go for that more cost-efficient alternative, which is going to be the Class C plus, B minus suburban office, right? So they're going to do okay, long as your bases are good and reasonable. But the Class A, we call it trophy assets in the CBD markets, are going to suffer even further down. If you see the dominoes are falling, real estate is a lagging indicator compared to the stock market or the fixed income markets, which are a lot more liquid and a lot more fluid versus real estate is a lot more illiquid in nature. So the ramification and the falling comes usually after. So you'll probably even see further decline 6 to 12 months down the line. And a lot of people kind of mistake interest rate because, there's a direct correlation with interest rate with cap rate, right? So when the interest rate drops, there's a compressed cap rate. Things get more expensive. There's an asset inflation. I talked about it in different videos. In this kind of market where the recession is looming, when the Fed reduces the interest rate and cuts the interest rate, they're doing it because the economy is not doing very well. So then even though you think that's a good sign, it's really a negative sign. So be cautious about that because initially when the interest rate cuts significantly and most people are going to be, oh my God, the rates came down to, 5%. I'm going to go buy a house. Yeah, initially in the first, 3 months, 4 months, you may see some pop in home values or CRA, but CRA is a little bit different than homes. They will kind of see that fall through because when the interest rates are cut that much, it's just economy is not that healthy. So it has an adverse effect in a constrained market. So that is also a very good time for real estate investors or any investors that have prepared for it. Prepare for this time, right? So if you were very frugal and be smart and didn't spend a lot of money and you saved and you have a lot of cash in a high yield savings or more liquid assets, right? That can be liquidated to go purchase real estate. I think that your opportunity is coming very soon. So don't get disheartened by these negative news. Focus on, wow, I'm going to get a bargain, right? So if you're preparing for something to grow your wealth for the family and you've been doing a very good job saving and living a moderate life, have a lot of discretionary cash, you're going to be an opportunity of a lifetime, I believe. That's just my opinion. A lot of smarter people might disagree with me, but commercial real estate is really driven by the NOI, right? So that operating income of that asset. So if you get 50% occupancy and 50% vacancy, you're going to get a great deal. So as long as you have the good basis, you take a moderate leverage, and you are very savvy at operating it and, you're hands-on, I think that'll end up very well for you. I think the multifamily spaces, I think most investors understand multifamily much more than, commercial office or retail because multifamily is closer to single family homes, right? So it's more natural for them. Like if someone moves out, I could refill it with new tenant or new occupant. And usually the leasing period is a lot quicker. We call it absorption period versus an office space or retail or even, alternative assets where it may take you 36 months to lease that space. And that 36 months, you're not getting any income. So multifamily, I will focus, is probably going to be still the most resilient asset class. Given, home ownership in America is much tougher for Gen Z and millennials. I get it. I think I'm a Gen X. I'm at the cusp of Gen X and millennials, so I kind of gave up my age. And I mean, a lot of the older folks will talk about, millennial and Gen Z, they're lazy, they don't know how to work. I disagree. At every generation, there's going to be inadequate people. There are going to be successful people. But one thing is, I'm a parent and, you want the best for your kids. So you wouldn't do anything that's going to be detrimental to your kids. So government and older folks like the boomers of the world, they should be looking out for the future generation. So, the more we spend, there's inflation. We're really taking your future earnings and we're spending it today. So it makes it a lot tougher for you. So then that shouldn't be doom and gloom and be like, oh my gosh, our generation is messed up, it's effed up. No, it's not. You just have to be focused, more focused than your parents' generation. Because in my perspective, you guys are the most educated generation that has the most information readily available in your hands. You can have you gotta have to discern facts and information correctly because there's just so much data dump out there. Good information, bad information. So you have to be very analytical. But once you use that to your advantage, you're going to be a lot more savvier, a lot more efficient than your prior generation, my generation, or even my parents' generation, which is the boomers. So stay resilient, read these news, and understand there might be an opportunity coming for you if you've been prepared. I like these kind of news. I understand people are going to lose money, and there's going to be investors who work really hard to invest with Brookfield, Blackstones of the world, all these Vanguard, BlackRock. I get it. However, that's a risk you take. If you invest, you're putting your principal on the line. But there is always going to be a transfer of wealth. Money is transferred. It's not created. It's transferred. So someone has to lose the money for someone to gain the money. And that's a true fact. No one can win-win together. Look at the stock market. If I'm losing money on Intel, someone's making money on Intel. It just doesn't disappear. It's transferred. So when you look at these, be smart, be resilient, and even though it's doom and gloom, start looking at deals now. If you're prepared now, you see the metrics. As an example, right? In Phoenix, when I was looking at, class B minus asset, the unit was trading at $86,000 per door, per key, and per unit. And in 2021, that same asset that I passed for $86,000 because I thought it was too rich, sold for $235,000 per unit. Now they're on the market distressed. And they're trying to sell it for $150,000. And that's a fair price in the market today. But with economy slowdown, I think that's even too rich. Because unless you have like a 10-year outlook, you're going to have to bear through the hard times. So if you wait 12 months, 6 months, 8 months, that might come down to $110,000. $110,000 with the current market, what the rates are, that might be a good entry point. So don't get too worried about it. If you're hearing these kind of negative news out there, that is a telltale sign that opportunities coming for people who are aware of it and people who are prepared for it. I don't have a crystal ball, but for me personally, I'm actually looking at deals now. I'm looking at alternatives, yield generating. Now, I haven't touched multifamily in a while, but I think it's very interesting now, interesting time where I'm actually looking at multifamily. 20 unit to 150 unit is my sweet spot. I mean, I could go to 200, 300 unit, but I think, 20 to 100 units, depending on the region, it's an ideal deal size because I'm gonna be putting down a lot more equity versus getting financing because I want to have a lot more control of my cash flow. And just, sometimes even though I'm a professional, there's gonna be always factor. I mean, look, I might miss it. I don't have the crystal ball. If I had a crystal ball, I wouldn't be sitting here. I'd be a trillionaire, right? So I want to be prepared for that. So retail asset class, main on main, I think is still very good. Single tenant net leases, again, still there's some transaction happening. When I say single tenant net lease, is it going to be like Hobby Lobbies of the world, Starbucks, Wendy's drive-thru, things like that. Because there's lack of 1031 proceeds. Because traditionally, a lot of 1031 proceeds came from older boomers who sold their 20-unit multifamily they bought for $500,000 and they sold it for $8 million. They don't want to pay capital gains, so they're going to go buy and trade that for 1031, but they want to go really passive. Now they're 65 or 70. They don't have that energy to monitor all that, so they're going to go into super passive triple net leases. That's going to give them a coupon. So that was the boom. When the things are going up, you had a lot of 1031 money is recycling into triple net leases, single tenant net leases. So there was a lot of transaction activity, but now that has died off. So that impacts a lot of retail assets too. So they're all correlated, the market, interest rate, proceeds, equity. Right now, equity is very expensive. So syndicating is a little bit more challenging. So just be mindful and take this as an opportunity for younger investors out there who wants to jump into owning a real property. I didn't say it was easy. You may lose money. You may lose some more hair like me, grow some white hair, but I think that's the journey that all investors need to take. No action means you wouldn't know. If you take no action and just keep always thinking about it, like one day, how would you ever become an investor? How would you ever own real estate? How would you ever own investments? how would you even own your business? You have to trust in yourself, read, prepare, do the hard work, and get ready to take the leap of faith and bet on yourself. And I think I'm very fortunate and very thankful for all the people who support me, all my business partners, my investors, my family. So that was pretty lengthy, but hopefully that kind of gives you how I'm seeing the market next 6 to 12 months. Interest rate will definitely come down. Price will fall. You'll see a lot more distressed assets in the market, even retail, multifamily, and office. Now, how do you retrofit the office? Highest and best use. How are you going to get Class B multifamily or Class A multifamily if you have a big syndication pool of money? So those are the strategies that you need to think of. But for me, I'm actively looking at deals now. And I'm anticipating to close more deals, maybe Q1 after the election. If I want to close Q3 of next year, I got to get a deal locked up in escrow by January, February of next year, because real estate takes a very long time to transact. So hopefully this information was helpful. If you found this content helpful, please follow, like, and add comments. Thank you very much.